Good evening and welcome back to Be Rich. Today I wanted to give you a fair idea of why cycles happens in markets. Cycles are there are certain periods when markets go up very high and remain elevated above fair value, and then there are cycles when the market drops and then it drops way below the what is called as the fair value. Like a pendulum, the market swings from extreme overvaluation and at times to extreme pessimism in undervaluation. If one has to really understand this, then one has to go back 22 years because the last original bull market, which was caused by a wave of optimism, was the great tech market, where they thought that the internet was the thing and it would change the world. Some companies survived from that, Amazon being the most notable survivor. But immediately when the optimism failed, the market tipped over, corrected, and it took a long time for the market to recover. That was the time when Greenspan announced his famous put when he decided to cut interest rates regularly to bring back the market to normalcy. A put gives you the right to sell a stock at a particular price or an asset at a particular price. Basically, he was putting a floor on the asset prices. This he did when the Nasdaq collapsed by more than 50%. The rise of markets before 2007 and 8 was parabolic in the sense that the Nasdaq had not crossed its previous peak and the euphoria was pricked not because of any market of people losing optimism, but was the failure in the housing bubble market, where banks had written too much credit and people who didn't deserve loans were given loans. And not only that, the loans were diced and parceled into pieces and sold back to pension funds and other funds as secured assets, with the rating agencies playing a dirty game. And then you had your futures where people were betting on the outcomes of the market. And this market, finally, one market does not keep on going up in one direction. Housing prices collapsed, and finally, the real estate bubble collapsed. People could not pay back the mortgages, and this created a situation of panic and solvency in the major financial institutions that led to the collapse of the stock market. Even to the point up to 2020, in the American market, the prices were generally moving up gradually. It was parabolic. It was not a sudden rise. The collapse came not because of any technical reason, but the fact that the COVID-induced pandemic had forced the government to lock down their economies, and this related in the crash. The Federal Reserve, the Bank of England, and all the major central banks piled in to put in a lot of money, and money was given away free to a lot of people to make sure they could sustain themselves. This money also percolated into people who already had enough for survival. They decided to go in and buy into markets because they found it too cheap. This caused the relentless rise of this market. But like all good things have to come to an end, even this good thing had to come to an end because too much demand made sure that we would have inflation in the market. And there was also an external factor that the Ukraine-Russian war would create a shortage of commodity, and commodity prices went through the roof. Especially food like such as wheat and sunflower oil went through the roof. This, along with rising crude prices, made sure that inflation was way above what the Fed expected. The Fed had to move quickly and raise interest rates to make sure that the economy would cool, and the markets reacted by dropping in price immediately. And then you almost had a technical bear market. The market has since recovered about half of what it gave up. But at the end of all this, we still don't know what is a bull and a bear market. A bear market is technically defined as something which, if you fall 20% from a peak, it is called as a bear market. And if you breach the previous high, it is considered a bull market. So for a real bull market, the S&P 500 has to take out the previous high. And for the real bear market, the S&P 500 has to breach its previous low. But actually, if you look at the average returns for the S&P 500 from 1957, where this kind of data is available, you would find that the average mean return is 9%. But from 1957 till date, there have been only 6 occasions where the Fed has returned between 8 and 12%. Most of the time, the results given by the S&P 500 are way off the mean of 9%. Like I pointed out, with a tracking hour between 8 and 12, only 6 from 1957 till today. That is in nearly 60 years, only 6 occasions has the S&P hit the mean return. Why is this? If the S&P 500 were a mechanical machine, it would keep on giving you the returns that you desire. Unfortunately, investment is a lot of psychology and very little finance. Millions of people across the world converge on trade on the S&P index. The psychological fear or euphoria of this mass determines whether the index is up or down. And therefore the index is never near the fair value, which is the mean it has generated over the several years. When the mass of people expect economic conditions to be favorable and very good and very nice, and they expect companies to take advantage and make profits, they keep purchasing stocks beyond a level. This pushes the price of the stock higher and higher. This causes a bull market. When people realize that the euphoria which they felt for this market is not true and the market will tend to correct, that and the economic situation is not as good as they thought and things are bad, then the market will begin to correct. The market is not a magic point where it will stop at the exact midpoint. What will happen is the market will sink behind the midpoint and go towards well below the point of fair value. Once the pessimism is over and the worst is behind them, some people will believe that the assets are highly undervalued and they can be picked up for a bargain. Then people come in and buy for a bargain. The prices begin to rise towards a fair value and over a period of time cross the fair value and go to the peak. The length and the time of the cycles are determined by the policies of the central bank on how cheap money is. If money is costly and not available, then a bull market will not keep on going on forever, will have to stop at some point. If the Fed tightens beyond a point or the central bankers tighten beyond a point, the bear market will last for a longer time. But one can be certain that it is not going to hit the mean, and history may not repeat itself, but will definitely rhyme. Thank you for watching. Be rich. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.